Hi everyone, welcome to the next episode of Unfiltered Investments. Joining us today is Mr. James Varela, who is a partner at Rede Partners. He's a fundraising specialist where he helps private equity and private credit GPs raise capital from LPs all over the world. He has his experience from Europe, UK, and now in the MENA region. He's firsthand seen how LPs think about investment, how the fundraising process actually works, and what separates a manager from raising capital to the ones who don't raise capital. So please welcome Mr. James Varela. Before we dive in, I want to take a moment to thank our venue partner, On the Road Specialty Cafe, here in Al Quoz. They've been kind enough to host us, and honestly, it's one of the favorite spots in Dubai. They're all about quality coffee, a warm community vibe, and creating a space where people actually want to slow down and connect. So if you're in Al Quoz, definitely stop by, grab a coffee, and experience it for yourself. Huge thanks again to On the Road Specialty Cafe for being such a great partner and for supporting Unfiltered Investments. Hi, James. How are you? Thank you so much for coming all the way.
Pleasure.
I know it's been a very hectic week or month for you. So, where all have you traveled? What's happening? What's the activity looking like in the market?
No, thank you for having me. It's a pleasure to be here. It's been a very busy period, certainly after the summer. Lots of travel across Europe, US, and the region in particular. Meeting with investors and also prospective and existing GPs to get to know their strategies and see how they could fit into this region as well.
So, let's say when you travel, I've also seen you go for a lot of conferences and things like that. What do you like about conferences and what you don't like about them?
It's a good question. So I think conferences are a great way to meet a lot of people. And I think there's two aspects to that. A lot of it is about reconnecting with existing relationships and maintaining those relationships. The other part is obviously finding new prospective investors and as well prospective clients. And I think conferences are just an efficient way to do that. Now, the challenge sometimes is that some of these conferences are very hectic and very busy, and the quality of dialogue is maybe not the same as you would have if we were having a one-to-one chat like we are today. So a big part of it is, yes, it's efficient, it's a good way of doing that, but then you have to normally follow up with a more detailed discussion, particularly with the groups that you found interesting. It's a good way of testing the water, and similarly for investors, it's a good way to get to know a broader aspect of the market and see where things can fit into their portfolios.
Okay, that's interesting. So I would just want to talk about your journey, how you started, how you came here. And I know you've been around in different countries. So how did that look like for you?
Yeah, so moved to the Middle East relatively recently as part of my role as head of MENA at Rede. I think for us, the MENA region is really a strategic priority and something that we want to continue to build our coverage and our focus of. We see that as an imperative for our own global business, which has grown significantly now. We're about 150 people globally. And for us, it's really about serving the LPs here in the best way we can. And by being closer to that market, we can do that. It's clearly quite different to a lot of the other markets that I've spent time in, and I've covered various regions over my career. And I can touch on some of those nuances if that's helpful.
Yes, please.
So I think looking at some of the European regions that I've spent time in, often some of these have been some of the more mature regions, such as the Nordics and Switzerland, for example. And in these regions, you found that actually a lot of investors have invested in private equity and private markets for quite a long time. So they have quite stable, quite mature portfolios. Now, in the Middle East, it's a relatively more nascent sort of market. Of course, some of the sovereign wealth funds here have been investing in private markets for quite some time. But certainly when you look at sort of the more institutional family offices, a lot of those have spent time in either domestic real estate, a little bit like some other European markets I've covered, particularly Spain as an example, and are now looking to diversify their exposure, both in terms of asset class and in terms of geography. So there's more education to be done here around what does private markets bring to the portfolio? How should you think about diversification? How should you think about geography and sector and covering various aspects and subsectors within that? And then the other aspect is, I think, the European investors in most cases are very set up to evaluate investments in a quite a streamlined way, given that they've been investing in these asset classes for a long time. So actually here, that's obviously true of the sovereign wealth funds, but certainly for some of the less sophisticated investors, there's a desire to do more work and to focus on more established brand names, where they feel a bit more confident from a risk perspective. And I think there's an education around what does that bring to the portfolio versus some more, let's say, lower mid-market or mid-market opportunities that can also be very attractive and generate higher alpha for those investors. And the final piece I think I'd touch on is in terms of speed of execution.
Yeah.
So generally things move at a slower pace here than in Europe. And that's really it takes time to build relationships, it takes time to build trust, and you have to be prepared to spend time doing that. That's really important.
Thank you. So we've talked about a lot, and I'm going to break everything down. So just to begin with, you spoke about Nordics region. Could you tell what all regions are covered under Nordics?
Yes. So the Nordics typically includes Finland, Norway, Sweden, and Denmark. And though as core regions, and most investors kind of lump that into the Nordics. Now there are some specific country-focused investors in each of those countries, but then there are a lot of GPs that tend to cover that region as a whole. And that brings greater diversification to an investor if you're investing across that. Having said that, each of those regions does have its nuance. So again, it really depends on the sophistication of the investor and the size of the portfolio, whether you look to invest in one GP to kind of capture that space, or you look for specific country funds in each of those regions as well.
So coming back to your private markets, right? Could you tell us what kind of asset classes are there in private markets? And if just we can break down a little bit on that.
So private markets is quite a catch-all term. And within that, you have numerous aspects. You have private equity, you have private credit, you have infrastructure, you have real estate. Within all of those, there are various levels of kind of risk tolerances and kind of roles that they would play within a portfolio. For us at Rede, we focus predominantly on private equity and private credit. So those are the two areas that we spend time on. And they bring different things to a portfolio. So private equity can then be divided down into, buyouts, growth investments, and VC. And private credit really covers a broad spectrum of different types of debt instruments, right down from direct lending to the more sort of distressed special sits type investments. And they bring different things to a portfolio. So typically the private credit angle is more yield and income oriented, and tends to have a faster sort of return profile. And private equity is more focused on long-term capital growth.
So could you just break down buyout, growth, and VC?
Yes. So within taking VC, again, it's not a space we spend huge amounts of time in, but there are various different aspects within VC in terms of when you're investing into a company. Typically, these are the earliest stage investments that you would make, so are normally characterized as higher risk than a buyout fund, which is a more established investment profile. And within that, you're looking at often investments that are not generating a profit, but have the opportunity to deliver outsized return potential. So clearly within that, you're taking a bit of a higher risk. You typically want a more diversified portfolio, and most VC funds just invest in a lot more investments than a typical buyout fund. Growth kind of sits in between the VC and the buyout space, and there's many definitions of growth. It's a relatively complex part to kind of define very concretely, but I would say generally within growth, often these are more minority type investments, and they are businesses that are showing a path to profitability or are profitable, but are still in the early stage of development and are going on a significant growth curve. And then buyout is really more established companies that are being acquired by a GP to go on the next phase of growth.
Okay.
And that GP can bring value creation through various tools that they have at their own disposal.
Okay, got it. So now let's come back even more before. So we spoke about LPs and GPs. Could you tell us who these two people are in an entire, let's say, fundraising process? Okay,
Sure.
who are LPs, who are GPs, different kinds of LPs and GPs?
Sure.
And where do you come in between?
Yep,
as
of
your
course.
role? Yeah.
So GPs are essentially the private equity investor that buys the companies and the businesses. So it's essentially the fund.
Okay.
The LP, the limited partner, is the investor, typically institutional investor, that invests in the GP and the general partner in the fund to achieve returns.
Okay.
In terms of where we come in, so we're a fundraising advisor, so we work with both GPs and LPs actually to deliver their objectives. And for us, the GP is the client, so we work with the funds to raise capital for them. But as I always say, the LP is really my client because my focus is on ensuring that I understand exactly what that LP needs and finding the opportunities that make sense for that LP to invest in. And as part of that kind of process, I think for us, and we like to do things a little bit differently, it's about, so first and foremost, really having an in-depth conversation with the investor to understand what are the objectives, what are you looking for, what are you not looking for, and being really thoughtful around that. For the GP, it's about being very efficient with their time.
Okay.
So I think coming back to what we do, obviously raising capital for them is just one aspect of that. A lot of questions I often get around, well, why do we need a fundraising advisor? Why do we need a placement agent? There's a number of reasons. One, GPs and funds are set up to invest capital. So to be efficient, they should focus on investing capital, not necessarily fundraising. Having a specialist that can help them do that is important for a number of reasons. One, we can help them craft the story and tell the story in a way that LPs understand and that LPs resonate. We're obviously very plugged into the market and what LPs are looking for at any particular point in time. And in order to be efficient, it's really important that you focus on finding and spending time with the LPs that are most relevant to you.
Okay.
And so a big part of what we do is making that process very efficient by knowing what LPs want and taking the right GPs to the right LPs. And if you get the equity story right, so the positioning piece right, you go to the right LPs, you're more likely to maximize your fundraising success and have a much more efficient process, which again is just more effective for a GP. You asked about LPs and the types of LPs. So just to touch on that a little bit, it's a very wide spectrum of different types of LPs, particularly for this region and probably at the larger end, it's the sovereign wealth funds. So these are quasi-governmental vehicles that are designed to invest on behalf of the countries that they represent. They typically have very large pools of capital to invest and invest in a very diversified portfolio of different types of investments. Then you have sort of quasi-government institutions, so things like pension funds, for example. These can both be public or private. Again, they have a very long-term horizon and long established kind of processes and procedures for investing in private markets. And then moving down into sort of endowments and foundations. So these tend to be groups that are more open to doing newer managers, for example. They are investing on behalf of, say, a university, for example, and their role is to grow the endowment of that university to be able to fund scholarships or whatever may be required. Then you obviously have banks, insurance companies, financial institutions that invest in private markets, and then right through to family offices, which are investing on behalf of the principals. That can be a single family office, investing on behalf of one family, or it could be a multi-family office investing on behalf of a number of families or investors.
Got it. So I am first going to start on the GP side, how you deal with them, and then go into LPs.
Sure.
So coming to GPs, do you approach GPs or GPs approach you? How does that process look like?
So it's a little bit a combination of both.
Okay.
So we have a lot of inbounds from a lot of GPs every week, and that's great. Obviously, as part of that, we have to triage that and work out which groups fit within what we might want to do. And at Reed, we have a very focused model. So we're not doing 40, 50 funds at any one time. Every single slot for a particular GP is very valuable. So when we decide to spend time with a GP and dig in, we spend quite a lot of time doing that. Often we like to get to know people a couple of years in advance of fundraising. We do a similar process that an investor would in terms of due diligence, including lots of referencing. And we're a very conviction-based organization. So for us, it's really important that the team is bought into what a GP is looking to do or is doing, and that it fits within our model and where we believe we can add real value. And that's kind of how we think about the GP piece. Now, the flip side is obviously we have a view which is informed by our global coverage team. And the conversations that we're having with investors every single day around which GPs are most attractive. And that varies region to region, of course, and we can touch on that a little bit later. But as part of that, we like to know who is interesting in the market today to investors. And we kind of collate that intelligence and figure out, okay, this group of GPs are interesting, we should spend time with them. Maybe they haven't reached out to us, and then we will proactively go out and get to know them if we don't know them, and figure out whether it's something that could be attractive to us. And
so when you choose a GP to onboard, what are top 3 things that you look for?
Top 3 things, I would say number 1 is probably team for me. And as part of that, I think there's a number of factors within team. It's tenacity, it's the ability to see a cohesion around the culture of the firm. To see a very driven, motivated set of individuals that have a very clear view in terms of what they want to achieve. It's experience, and it's also alignment. So are the economics fairly shared within the team? Are they investing a significant GP commitment which shows alignment to investors? All these things. I think team is probably where I would start. The second thing I think for me is obviously track record and performance. And we work with a lot of emerging managers as well. Often that requires more work to figure out their prior track records. But as part of our analysis, it's not just, okay, what's been the performance of the last 4 funds? It's around the nuances within that performance, the loss ratios, the level of DPI, the volatility, the benchmarking. We do a lot of work on that. And then the third piece is really their right to exist and their differentiation. And for that, it's around the strategy, and do we feel that this is an interesting part of the market, that this GP has a particular edge in, and can we craft the right equity story around that is something that will resonate with LPs. And that is the hardest bit to often figure out, because some of it is more nuanced. It's more qualitative, but if you do that right, you tend to build a really nice portfolio of GPs that are really well regarded amongst LPs.
So when you come to track record, could you talk about like 2-3 metrics that is very important when you're looking into a GP?
Yeah, so I think it depends a little bit on the stage of GP. So for us, clearly, I think consistency of track record is one of those things that we look at. And sometimes GPs have more volatility in the track record, and that's fine. Different strategies can lead to that. But we want to see a kind of consistency to what is driving those particular aspects of the track record. Again, I think it's around the profile of deals, and the portfolio construction is probably the other thing I would say. So, is the portfolio kind of consistent in terms of equity ticket? Is it within the strategy? Or have there always been one or two things that sit a little bit outside of the strategy where they might have got lucky on or they might have not? And what does that mean to sort of investment discipline? And I think the third piece for me is actually around exit discipline in particular.
Yeah.
So I think it's too easy for investment professionals who have spent a lot of time cultivating a relationship to be able to source an investment, to fall in love with that investment a little bit and to hold on to it for a little bit too long. And I think sometimes you have to decide and be quite rigorous around when is the right time to exit. Have we delivered the vast majority of value creation in this particular asset? Is it now time for somebody else to own it who has a better skill set to do so? Or are there more levers we can pull and therefore it makes sense to hold on to it for longer? But I think that kind of fund management aspect of working out which investments you can probably exit a little bit early makes a lot of sense as well.
Yeah, true. Exit part, I think, is something that a lot of people don't think about.
Yeah.
But then if I want to get into metrics like IRR or, MOIC, DPI and all of that, could we just touch upon it a little bit?
Sure. So I think today DPI, which is essentially a measure of capital being returned back to investors, is more important than ever. And that is partly because of the market dynamics today. So clearly it's been a very challenging environment, not just for fundraising, but also for investment. And there haven't been as many exits, so as much capital return to investors. And so investors are much more acutely focused on how quickly they can see capital back. And that may well impact how they think about sort of re-up, so reinvesting in a GP's subsequent fund. IRR is more of a measure of, again, sort of the speed of capital being returned. And then MOC is around the long-term capital appreciation of an asset and the ultimate return that will bring. And different investors prioritize different things. In this region, actually, interestingly, a lot of investors are more focused on IRR metrics. Certainly at the larger end and the more institutional end. Part of that is in terms of alignment with compensation, but it's really interesting because most of these investors don't necessarily need capital to be returned, given they have very large pools of capital that they need to deploy.
What is IRR?
So that is the internal rate of return. It's a percentage based on how quickly you're getting your capital back and how much you've deployed.
And the other thing you spoke about is the return, the MOIC, multiple on invested capital. Which one do you think is more important in theory?
So I don't think there's a clear answer to that. I think it depends on the situation and the type of risk profile that a particular fund is delivering. I would say, again, it's really down to the objectives of the investor. So some investors are more focused on having their capital back early and being able to redeploy that, whereas others are happy to leave it within particular investments and have a higher overall return in the long run. And so there isn't a really straightforward sort of answer for each LP.
Okay, got it. When did GPs start thinking about fundraising from the MENA region?
Yes. So I think some GPs have spent, a long time here and were early to the party in the sense of investing both time and resources, getting to know investors in this region. Obviously, as the fundraising market has become more challenging, more GPs are spending increasingly more significant time in the region. And I think it's, this region does not necessarily serve every single GP in the same way. There are particular nuances around what LPs are looking for. And you have to invest the time and energy into working that out. And that's why a good fundraising advisor can help with that. But it's generally not helpful to just turn up kind of looking for capital straight away. You need to build those relationships. It takes time. it takes energy, and over time they will become fruitful, but it's not an overnight solution.
Okay, so like if you were to give me a number in terms of years, how many years back do you think like they've started showing more interest?
I think probably in the last 10, 15 years there's been
Okay.
greater interest.
Okay.
Obviously, it has exacerbated a lot more over the last sort of 4 years, let's say.
Okay.
But sort of there were some early adopters of that quite some time ago that were able to do a great job of courting the key investors in this region.
So do you think GPs have now started trusting MENA region as a long-term LP partner for them, or are there still some hesitation from LPs outside?
I think there's always...
Sorry, GPs outside.
GPs outside, yeah. I think there's always the odd hesitation from different GPs, often those that are less familiar with how this region operates. I think the necessity aspect today of capital for a lot of GPs means that they have to kind of spend time here. I think the challenge sometimes comes where there's a bifurcation or a disconnect in terms of what a GP is looking for and what LPs in this region are looking for.
Okay.
And a big part of that is co-investment. And sometimes there are GPs where strategies just do not lend themselves that well to providing ample co-invest opportunities. And in that case, there's a bit of a disconnect in terms of what they can offer and what this region is looking for. And that sometimes makes it challenging. And then I think sometimes you have some very high-performing GPs that feel very happy in their domestic market, where they don't feel the need to have to travel outside of that or invest the time in getting to know investors outside of their own domestic markets. And in those cases, again, there's a bit of an education in terms of thinking strategically and thinking about the long term and what this region can bring over time. It may not be for this fund, it may not be for the next fund, but actually it is worthwhile spending time to get to know the key players and build those connections and those relationships.
Do you think for a GP it's important to diversify their LP base? Or let's say if they're doing well enough in their market, you know, they're already oversubscribed, then they don't really have to reach out to the MENA region, you know?
I think it's very important actually because, and that diversification can come in many ways, right? Okay. It doesn't have to be geographically, it could be by type, and it could be by size. But there is always a risk, even if you're performing really well, that you have concentration in your investor base. And that could be amongst maybe some of the consultant relationships that you have that oversee a number of relationships within your investor base. It could be because you have one or two large anchor investors that backed you in the early days and have continued to increase their commitment size and back you over the long term. But I think it's just good hygiene to really think at every point when you're thinking about fundraising again, how does my LP base look today and what is the optimum LP base of the future? And it's different again, depending on the type of GP, the geography, the evolution, the fund vintage, all these kind of things. But actually, if you can build a very nice diversified group of investors by size, by type, and by geography, you're de-risking your long-term risk that any one of those groups diminishes for global macro reasons or any other reason. And you have the capacity within the rest of your investor base to absorb that as best as possible.
Okay, got it. So now we'll go into the LP side of things.
Sure.
Right? So you have been a fundraising partner here in the MENA region and in Europe as well. What do you think is different between these two regions from the LP perspective?
So I think from the LP perspective, again, this is a little bit of a generalization, but to give you a feel, clearly in this region, there are a number of very large sovereign wealth funds that deploy a lot of capital. They have particular objectives as part of that. Often, a big part of it is they want to grow their direct investment base.
Okay.
And they want to grow their co-invest portfolios. So they want to own assets. Typically in Europe, there's often a desire for co-invest from investors, but it's smaller and it's less pronounced than in this region. And a lot of those large sovereign wealth funds have dedicated sector teams to analyze particular investments and can take very sizable positions and acquire very large assets as part of that. So that is one feature that's quite nuanced to this region. I think the other thing that is quite different is, generally speaking, and this is more of an evolution over time, that a lot of the investors have a very forward-thinking vision in this region. And that is really around what are the objectives of their particular country or organization, and I'm talking about sovereign wealth funds here. And that can often mean that they're looking for GPs that can bring particular expertise and skills to the region. So that could be around decarbonization, which is a theme that is certainly of greater focus today, as a lot of countries in the region look to diversify their energy mix away from oil and gas. It could be around the digitalization of businesses and, again, AI, which is very much a focus of the UAE in particular, but a number of countries in the region. And if you have particular expertise in that set, how you can bring that to the region. And then also it's around what you can bring in terms of economic benefits to the region. So that could be in terms of setting up offices here and bringing teams here, or it could be around bringing portfolio companies to the region that can help grow other businesses, or it can be JVs, so finding a partner in the region that can help your business grow and their business grow symbiotically. And I think where you have those kind of overlapping areas of mutual benefit, it can really bring a lot of value to your ability to sort of fundraise in this region. In Europe, given it's a more established, more mature, generally speaking, more stable private equity environment, most of the investors are not writing tickets in the same size that investors are in this region, certainly at the larger end, and are more focused on a diversified portfolio of investments. And the other thing I would say is that there's a greater tilt to North America in this region. So probably 70% of portfolios on average are tilted towards North America, where there is a historic bias that performance has been very good, and if you can find the right players, you can deliver outperformance. Having said that, I think that's slowly shifting.
How is it shifting?
So I think the global macro environment means that investors have reassessed how they're thinking about things. And Europe is increasingly playing a more important part in terms of how they think about their own diversification, and whether they want exposure to particular parts of Europe, but also particular sectors within Europe. And that is a slow transition. It's not a wholesale change. North America will still be the most overwhelming part of portfolios, but you are seeing a greater shift to diversifying that a little bit more towards Europe, and again, a little bit more towards Asia as well.
So when we come back to Europe, what kind of LPs are there in Europe, like predominantly?
So again, within Europe, it's all the key players that I touched on earlier. Sovereign wealth funds less so.
Okay.
But you do have a large sort of pension fund and insurance community, and then you have very large sort of family office type network across Europe. And then there's clearly some endowments and foundations and insurance companies and everything else. But it's a very similar mix. I think just this region has more of the sovereign wealth type quasi-government investors, which can write significant tickets.
So if you were to give me an average ticket number, what would the difference be in Europe versus MENA region?
Again, it's difficult to give an average across the board, but the sovereign wealth funds in this region can write 250 million plus investments. Most investors in Europe are more around the 40 to 50 range. So there is a very big disparity as part of that.
So if you compare European GPs to MENA European LPs to MENA LPs, right? in Europe, do they focus more on investing in the region or outside?
I think this is changing. So I think in Europe, because they know the European market very well, there is a greater tilt towards European investment, so investing in European GPs. I think what you are seeing here, again, coming back to my earlier point, is around greater focus on what people can bring to the region and to their own countries. So I think that's a slight nuance. And that's ever evolving and ever shifting. I think it will continue to change.
So, which also means that the return number or goal of how much returns they want to earn would also be different?
Less so on the returns. I think, universally speaking, most investors try and underwrite to a 2x and 20% net IRR.
Okay.
But there are nuances within that, in that if you are bringing something that's strategic, that can change how they think about the return profile. But generally, that's the accepted norm for most investors that they want to see from private markets and from private equity.
So in the MENA region, you mentioned that a lot of them invest in North America. Why do they not invest as much locally as opposed to outside?
The main reason is just that the local ecosystem is relatively small.
Okay.
And their requirement is to invest very large tickets.
Okay.
So there are very few funds that have the capacity to absorb their kind of investment ticket size. The opportunity set in MENA is much smaller than the US, obviously, in terms of the amount of deals that are getting done and the opportunity to deploy the kind of capital that they need. Obviously, over time, that will evolve and that will change. There are some very good local GPs, and some of the family offices and stuff do back them. But certainly at the larger end, it's just difficult because the market is newer, it's less proven, and it's smaller.
So in MENA region, what are some of the things that you see the country is doing which will help increase the ecosystem altogether?
So I think, again, it's very much early days on some of these things, but if you take AI and digital innovation, which is a very big focus for the UAE, what you are seeing is particular initiatives from government agencies to help bolster the ability for those groups that are investing in those particular areas to deploy capital here. I think in addition to that, you are seeing particular initiatives from sovereign wealth funds to help facilitate GPs to bring either portfolio companies to the region or set up offices here and build actual hubs here. And that's coming both in support of the actual infrastructure of setting that up, but also in terms of the capital that they can also contribute towards fundraisers as part of that. So I think that's definitely something that is growing in importance and is really part of the long-term vision of this region to continue to innovate and to provide a fertile ground for a lot of these GPs to continue to invest in.
Are you seeing LPs outside wanting to have some exposure to the MENA region in their portfolio?
Less so, unfortunately. So I think it's relatively small market. So most of the GPs that are more MENA focused have more MENA focused LPs. There are obviously exceptions to that, but most European, North American in particular, LPs have most of their portfolios in Europe and North America.
Okay, got it.
Maybe there's a small allocation towards Asia, but most are European, North American focused.
Okay, now we'll come to you. So you were talking about a model, about how you probably onboard a GP and then coordinate with the LP. What does the model look like?
So I think for us, again, probably at the center of it is conviction.
Okay.
And it's really around having multiple reference points that lead us to believe that the particular GP that we're going to onboard serves a particular part of the market that we think they have a real edge in. And again, it just takes a lot of time and a lot of data points that we get from the market to figure out who those are. But over time, you get to build a kind of pattern of what makes a GP successful, and you want to just use that knowledge to be able to help figure out who are the winners. And I think for us, I mean, we do quite a lot in emerging managers. So we like putting people into business. We think it's really important, and it helps grow the asset class. And that is something that over time, when you've seen so many emerging managers, you build a pattern of ideas and topics that continuously lead you to refine the strategy and find the GPs that have a long-term success mindset.
So when you say conviction, conviction on what?
So conviction on, I mean, for us, we're not a group that really fundraises with a group because we want to make fees and raise a fund, right? For us, it's, do we believe this is a long-term partner for us? Do we believe that they can grow with us over time and that we can be a strategic advisor to them? And we have to have conviction in the team ultimately, in the strategy, in the market opportunity, in the LP appetite, all these things. And kind of have that from across often, you know, quite a global perspective, which I think helps because there's obviously nuances in that.
So why do you think it would be difficult for a GP to reach out to LPs directly as opposed to reaching out to someone like you, which can make their fundraising process easier?
Sure. I think, I mean, GPs can easily work out who the right investors are, you know, who are the investors, I should say, in the region, and reach out to them. And, you know, if their performance is good and it resonates, then great. I think the challenge is that knowing who the right investors are is much more difficult. And where we come in, beyond all the other stuff that we do, is really around knowing which LPs are looking for specific strategies, geographies, whatever it may be, and where that particular GP fits into an LP portfolio. And if you get that bit right, it just becomes so much more efficient. So we can shorten the fundraising time significantly, which makes it efficient for a GP. They can spend time investing rather than on the road. We can refine the equity story, and in a challenging fundraising environment, actually the way you tell that story and being able to know exactly what the LP red flags are or pinch points are and address those proactively is quite accretive. And I think if you're doing that without real help from a specialist, it just makes it more difficult. So it's likely to take you longer, it's likely to be less efficient, and you may or may not have the same level of success.
So because you work a lot with the emerging managers, right? When do you know that, let's say if I take an example of first time fund, right? There's a manager who's starting their first time fund. What differentiates them from other managers? Like, let's say you know that this GP will do well versus the others won't. What qualities do they have as opposed to others? Especially, let's say fund one, when they're starting out.
Yeah. I think probably the two things that I think are quite important is tenacity.
Okay.
And what I mean by that is often a lot of these individuals have come out of very large, very well-established GPs. And if you're in one of these very large, well-established GPs, you have a lot of resource plus a very strong brand behind you. So that makes sourcing a lot easier. It makes value creation a lot easier. It makes connectivity and networks a lot easier. When you come out of that ecosystem, you don't have that in the same way. So actually, you know, one thing we look for is, do you have the tenacity to push through? I mean, first time funds raising is just not easy. It's very hard. Do you have the tenacity to push through that outside of that ecosystem? Do you have the staying power and the energy and the drive to continue until you get the fund raised? I think that's really important. And I think in addition to that, it's really around do you have the mindset to build the right kind of institutional setup from the beginning, and be patient about that. So often if you come from one of these very large, well-established groups, you have quite high ambitions in terms of fund size and ability to deploy capital and all these things. And sometimes you just have to start a little bit smaller, build your track record and as an individual, and kind of get there a little bit slower than you maybe would like. But essentially that is quite important, because then LPs can see, okay, the proof points in what you're doing. So I think that's really important. And that's kind of some of the things we look for in addition to all the other things that I've touched on.
So let's say if I look from an LP perspective now, right? How does their decision making look like? So let's say let's start from the beginning. They come to you, okay, or however, you reach out to them. What are the things that they tell you which kind of makes you understand that, okay, this is what exactly they're looking for? And let's say then you present a fund. How does that decision making look like?
Sure. So again, there's no sort of one size fits all. Different LPs work in different ways. I would say, generally speaking, for us, the first step is really understanding what an LP is looking for, coming back to that efficiency point. Once we've done that, and that changes over time, so it's something you continuously need to refresh in the conversations that we have. But once you've done that and you've figured out, okay, you've got a fund that really fits into what they're looking for, normally as you've spent time with that LP, you've built a level of trust and confidence that they understand that if you bring them something, it's normally something that fits quite nicely into what they're looking for.
Okay.
Clearly, if you spent years sending them things that are outside of the scope of what they look for, that's not going to help. So our focus is really on understanding what they're looking for and only showing them the things that they want. And then the LP decision-making process, in essence, is often a first introductory meeting or call. So typically that's around an hour. It's an opportunity to get to know the GP, understand the strategy, understand the market opportunity, the team, discuss the track record, etc. Then they will go away and take away and have an internal discussion. If they like that, they might request access to a data room where you have a full suite of materials to support the investment case. They will review that. If that goes well, the next stage would be a kind of full due diligence on-site day. Can be often done virtually, but often in person. That could be 3, 4, 5 hours.
Okay.
And that is an opportunity for them to meet the broader team, to dig into case studies, dig into the portfolio, dig into the pipeline, all these things. Once they've done that, they often take it to their investment committee for a preliminary discussion. If that goes well, then maybe there's follow-up questions from that. And they will get answered in due diligence calls. And then once that happens, often it'll progress to a final investment committee, which will then progress with legals, ODD tax, all these kind of things. And that process varies in terms of duration. For most LPs, on average, a 3-month process is probably about what you would expect.
Okay. So how many funds do LPs usually look into before they make a decision?
Again, it very much depends on the LP. I have some LPs that will map the entire market within a space and try and meet as many funds as possible to decide. And then there are others which have already sort of shortlisted a group of funds based on desktop analysis, which is often around benchmarking and references from the market, and decide, okay, these are the 6 funds we want to spend time on. Out of these 6, we'll pick 1 or 2 or whatever it may be. So there are 2 different ways to do that. It really depends on the capacity of the team to be able to analyze data.
Benchmarking, this brings me, right? If you could just define benchmarking in general, and what are different kind of benchmarks used for private markets?
Sure. So benchmarking is interesting. It's a way of LPs to see how a particular fund compares to the market.
Okay.
Now, in order to do that, you use data from a particular subset of providers that aggregate fund return data.
Okay.
The challenge is always, which benchmark do you pick?
Yeah.
And so I think with benchmarking, you'll kind of almost have to take it with a little bit of a pinch of salt. It is one data input, but it's not a hard and fast way of figuring out exactly who are the best players to invest in. I think it's just one data input.
Okay. Could you give some examples of benchmarks that are out there?
Yes, I think there's lots of. I mean, the most well-known ones are Cambridge Associates and Burgess, in particular, and within that there are different benchmarks that fit particular strategies or geographies. So then it's a question of where does a particular strategy fit into each of those benchmarks, and again, there's a bit of selection bias there, right? Because every GP is probably going to try and pick the benchmark that helps them present their case in the most attractive light. And then LPs will do their own benchmarking and decide whether that's the right benchmark or not.
Okay, got it. Now, if we come back to, again, LPs, right? In terms of their portfolio fit, now let's say you mentioned private equity and private credit and infra and real estate, right? Could you talk about their risk return profile and how do they fit in a portfolio altogether?
Yeah. So within private equity, obviously, there are various different aspects, as we talked about earlier, sort of VC growth and buyout. Generally, the risk profile is highest in the VC end and lowest in the buyout end within private equity. Private equity is more of a money multiple driven asset class, so typically have longer hold periods and is focused on delivering sort of 2x plus net money multiples. Within private credit, typically more focused on yield and delivering capital back earlier, but typically again, private credit strategies deliver a lower money multiple than private equity, but sometimes a higher IRR. And then infrastructure and real estate are more sort of yield plays again. Now within those asset classes, there are different types of return profiles between core, value add, etc., but are generally more geared towards a long-term, stable, yield-oriented return profile.
So, in terms of LPs in the region, what do they prefer more?
It's a good question. Again, it depends a little bit on the LP. Building a balanced portfolio, I think, is important for most LPs. What we are seeing quite a bit more appetite for is more hybrid type strategies. So these often sit kind of between structured equity and credit, and offer kind of a more risk-adjusted return profile. We're certainly seeing more appetite for those kind of strategies. But again, it's about building the right portfolio for the needs of that particular investor. Pension funds naturally have sort of longer duration horizons and want a more stable, yield-oriented type return profile, whereas sovereign wealth funds and family offices might be more motivated by a different type of return profile that's built on capital growth.
Got it. So now that we've discussed so much about LPs and GPs, we'll come back to you. How does your fee structure look like to begin with, and what is your highest cost in terms of getting all of this sorted before you close the deal?
The highest cost is obviously the team, because we have a lot of, we're a global team of around 150 people now, very well established and very experienced team that are very deeply networked within their own respective regions, so that is obviously expensive. I think in terms of fees, what I would say is, one of the advantages is we're independent. So we don't have any external shareholders, and that means that we can be very creative around how we structure things. I think the most important thing for us, and what should be very important to GPs looking to hire a fundraising advisor, is alignment. And so whenever we structure fees, we always try and look for how we are aligning our objectives with the objectives of the GP that we're looking to work with, and how does this present in the case of a kind of long-term mindset that we're looking for of working together.
So when we come to like a placement agent kind of a model, right? I see a lot of single people out there who act as the middleman in terms of making people meet, and they also obviously take a cut out of it. Uh, what is your view on those single people? Like, usually what I'm confused about, right, like they leave their jobs and they do this full time, right? So obviously like they should earn something to be able to do this full time, because obviously it's not easy.
Yeah.
And also it's different from the depth of services that you provide as a firm as opposed to a single person can provide, right?
Yeah.
Like you can already give the LPs a due diligence, a good idea. They have a foundation set in terms of due diligence, as opposed to a single person. There's only so much so that they can also do. But why is it that I see a lot of those people there? And just to get an idea.
Yeah, it's a good question. I think the challenge sometimes is that some GPs don't often understand the value that a good fundraising advisor can bring, and there's a feeling that maybe having one person in a particular region with good relationships can deliver results, which it may well do. I think the main difference is that those particular sort of one-man band type organizations don't bring the same global perspective to a particular region.
Okay.
And so in a lot of the conversations that I'm having with LPs, it's often around their own global ambitions around mapping markets and understanding geographies or sectors, and that we can bring to them in a different way. So it's around being able to add a lot of value to that LP as they think about their own strategic ambitions. And I think those local sort of one-man bands, it's more difficult to be able to do that because there isn't the network of intelligence that kind of we have flowing in every day. But I think there's probably, again, coming back to an earlier point around this misconception around what a placement agent or a fundraising advisor can bring to the table. It comes down to what you're looking for at the end of the day. And sometimes a kind of full service offering makes sense. And sometimes if you're a smaller GP and you want a particular angle in a particular geography, you might think that a kind of one-man band approach is more effective.
Fair. Coming back to GPs, do you think a generalist approach is better versus a specialist approach?
So again, it's a good question. I would say in today's environment, there has been a trend towards LPs generally shifting from more generalist GPs to more specialist GPs. Now, having said that, there are a lot of LPs that also just want a more generalist GP profile, and that's perhaps those that don't have large allocations to do 10, 12 relationships each year. Maybe they're doing 2, 3, 4 relationships, maybe some of the smaller family offices. And there they prefer a GP that can offer diversification across a number of different sectors or geographies, whatever it may be. I think what you are seeing, though, within is more specialization rather than sector specialization.
Okay.
So actually it's gone beyond this GP does tech, or this GP does financial services, or this does healthcare. It's more around, okay, within that, what are you focusing on? Are you focusing within a subset of healthcare, such as CDROs and CDMOs? Or are you focused in a subset of financial services that's more asset light, non-banking type assets, whatever it may be? There is an attractiveness around focus and really owning a particular niche. But again, it really depends on the situation. I don't think there's an answer that tells you that specialists are better or generalists are better. And I'm pretty sure that you can find statistics that will support both arguments. So it's more around what is the specific user need. and what is that GP delivering for that particular LP that others are not.
Got it. So what are some of the sectors that you see are in demand right now?
Again, it depends sort of region by region, and there isn't a catch-all. I would say for this region, I mean, there is quite a lot of tech exposure within portfolios already. I think that will continue to be important, and clearly, as I touched on, AI and digital innovation is very much a focus. But certainly healthcare and in particular industrials are areas where, and financial services. Actually, it's quite broad, but I would say those sectors are more focused on in this region.
Okay.
But it is almost less about sectors and more about the specifics of a particular investment.
Okay. Like what do you mean by specifics?
So I mean, again, this is focusing a little bit more on sovereign wealth funds, but because a lot of them are aligned on a sector team basis.
Okay.
Each sector team understands their own portfolio within that sector.
Okay.
And they may have a need for a particular area that they feel, for example, could be quite a nice add-on to something that they've already got, or they feel underweight in a particular subsector within that particular area. And so actually looking specifically for something that meets that need.
Okay, got it. So if I come back to returns, right? You mentioned something about alpha and beta. So if you could just break down what is alpha, what is beta, how should we look at it on a performance perspective?
Yeah, so beta is more, I mean, when I was talking about that, it was more around GPs and funds that rely on more of the traditional levers to deliver value creation, which can be around multiple expansion, so natural multiple expansion over time. It can be some of the more kind of traditional value creation aspects that are more sort of standard to most GPs. I think the alpha piece is more around groups that bring some sort of innovation to what they're doing in private equity that allows them to deliver outperformance versus the rest of the kind of private equity market. And what we are seeing today, and certainly more so than ever, is specialization around particular skill sets within GPs to deliver that kind of value creation. So beyond just sort of M&A integration piece, it could be around digitalization of portfolio companies. It could be around human capital management and the optimization of human capital within each of the portfolio companies. I think all these things are designed to try and deliver an edge that just relying on traditional sort of multiple expansion and leverage doesn't give you.
So in terms of value creation, could you list down how a GP can do value creation and which one is like something that you should definitely look for, like let's say top two?
So I would say, again, probably varies very much by strategy. I think buy and build is often used by GPs as a way of growing businesses quicker. And I think if you do that well and you integrate that well into each business, it can be quite accretive, particularly if you're buying add-ons at a lower entry multiple.
So what is buy and build?
So buy and build is when you have a particular asset, so you buy a company and you buy other companies that are in a similar space to grow that. It's M&A basically.
Okay, got it.
And that buy and build can be simply buying customers through acquiring competitors, or it could be transformational buy and build in the sense of buying adjacent areas that business is not already in, that can kind of add to its unique selling point and ultimately make it more attractive to an ultimate financial buyer, which could be a strategic buyer, could be a financial buyer. So I think if you do that well, and the challenge with that is obviously integration and making sure that as you're bringing in these other businesses into the mix, how do you integrate that into the one platform and make it successful? I think the other one that I think is key and is perhaps often hard to do is around management change.
Okay.
And so often you feel that you might have an underpowered management team for what you want to build, for what the ambition is for the business. But you can give them the benefit of the doubt because you want it to work out. And ultimately, management change can be painful, or is often always painful. And so as part of that, if you identify that you don't have the right management team in place to deliver the objectives, the value creation plan that you have in mind, then the onus is really on the GP to act quickly on that rather than, just...
So a great thing, by the way, that I've come across your LinkedIn profile is the market updates that you give every week. So I have a lot of questions around it, especially in the last 1 month. So what I've done is I went through all of your market updates for the last 1 month, and I have a few questions around it and
Sure.
what does the future look like. So to begin with, you mentioned about REIT's liquidity index. What is this liquidity index? How much has it changed, and why do you think, what does it look like for the market going forward?
So the Rede Liquidity Index is a way of measuring LP sentiment over the next 12 months and whether they are going to deploy more capital or less capital into private markets. And it's something that we've been measuring for a long time. We do that through our own LP conversations with investors, and we have a very broad set of investors that contribute to that, both in terms of geography, in terms of type of investor. So we try and get a very broad cross-section to deliver how we think about that. And it's really one barometer of measurement, and that's gone down, quite a bit, 15 points in the last RLI that we did back recently in H1 25. So that suggests that LPs will reduce allocations over time to private markets. Again, there's a lot of factors that can influence this. And the thing to bear in mind, it is a snapshot in time of what LPs are thinking. But I think a big part of that is just that distributions have not come through in the same way that LPs expected. So that has still been slow. And so they haven't had capital coming back from GPs. And that means that they're rightly cautious about how they think about their deployment plans into the future. So that will continue to be a feature, I think, over the next 12 months. But we like to monitor that and measure it and see how it changes over time.
So how much was it last year?
So I think, I can't remember the exact number, but it was above 50. In the last one that we did. So suggested people were increasing their allocation to private markets. In the last, yeah, exactly. The lowest it's been was back in 2022. And then in the last one that we've done, it's gone down quite a bit as well. But it's interesting. It kind of fluctuates with sort of market environment and dynamics.
What was it like during COVID?
So during COVID, it was relatively stable around the midpoint. I think during COVID, it's very difficult to measure because most LPs were figuring out, can you still get exposure to this vintage? In the sense of, up until then, we'd never really done diligence through a virtual means in terms of video conferencing and things like that. Historically, on-site due diligence meant going to visit a GP and do diligence, right? And I think for a lot of organizations, they had to figure out, well, can I do due diligence on a GP without being able to meet them in person? Can I do it virtually? And some got comfortable with that, others didn't. The flip side of that is obviously that if you don't deploy over vintages quite consistently, you get a disparity in terms of your overall exposure. And that can be positive if you get it right, but it can be negative if you get it wrong. So it's very difficult to judge.
So then you mentioned about LPs not getting distributions from GPs, which also led to you talking about secondaries. So if you could tell me what are secondaries and different type of secondaries out there.
Sure. So secondaries are really so kind of classified into two main areas, LP secondaries and GP secondaries. And this essentially when something doesn't involve raising fresh capital. So in the case of an LP secondary, it's a case that an investor, an LP, has a portfolio of funds or a fund that they would like to sell, and they sell that on to another LP. So that's an LP secondary. A GP secondary is often characterized as a continuation fund. And this can be a single asset continuation vehicle, which is with one asset, or it can be a multi-asset continuation vehicle, which has several assets in. And that is essentially a GP creating a new vehicle, which they would move a particular asset into and bring new investors on board, or existing investors would carry on their journey with that particular asset. And what we are seeing is certainly more demand for those kind of strategies, as LPs are looking for opportunities in the market.
Oh, okay. So just to understand more clearly, LP-led is when an LP wants to sell their ownership to another LP.
Correct.
And how often do you see that happening now, in let's say last 1 year?
Yeah, it's a very frequent part of the market, a very frequent occurrence, and a lot of that is driven by LP views around managing their own portfolio exposure.
Okay.
Again, coming back to my earlier point around the lack of distributions, it is a way of generating liquidity by selling some of those LP positions. And it is also a way of managing tail end exposure to portfolios. So often there may be a couple of assets that are lingering in a particular fund for a long time. LPs may want to clean up their portfolio a little bit and sell those off. And that's increasingly common.
Okay. Then coming to GP-led, you spoke about continuation funds. So essentially, from what I understand, is that their fund term is over or is about to get over, and then they move the assets into a different fund, or does it happen midway? What?
It can happen earlier than that. I think the typical use case for a continuation vehicle is that an asset is doing well, but the fund life is coming to an end, and typically what you would expect a fund manager or a GP to do is to exit that investment. However, for whatever reason, they feel that either they have another value creation journey to go on with that particular asset, that they haven't had sufficient time to do what needs to be done to that asset, or that it's a highly cash generative asset that they want to hold on to for longer. And in those situations, they may elect to create a continuation vehicle to do that, and to essentially move it into another vehicle, which investors may or may not continue the journey with. But it also provides liquidity for investors that say, okay, I want out. And it can sometimes bring in fresh capital via new investors coming into that vehicle as well.
So when I was traveling to US, maybe I think 2 years back, I heard something about GP stakes. So a lot of them were selling GP stakes. Could you tell me what is that?
Yeah, so the GP is the general partner that owns the funds, and sometimes, and this is again becoming more prevalent in the market, those have been owned by the partners of the firm.
Okay.
More recently, you've seen a trend of some of those GP stakes, so part of that GP being sold to other players, can be investors or can be specific funds that are acquiring GP stakes, which then allows those funds or those investors to benefit from the economics of the GP.
Okay, got it. So what I understand is GP stake is their ownership of the fund.
Correct. Yes.
Okay, got it.
Or funds if there's numerous funds that exist within a GP.
Got it. And how much percentage do they usually sell?
Again, there's no hard and fast rule. I mean, generally it's a minority, and often it's around the kind of 20% mark, but it does vary depending on the situation and what's agreed.
And why would they do that?
So often it's because they want to generate liquidity within the GP, often to invest a higher GP commitment in a subsequent fund, or because they want to monetize some of their GP ownership.
Got it. Okay, then the other thing that you spoke about is LPs moving from private equity to private credit. Why do you see this happening?
Yeah, and I think it's less a shift of not doing private equity and doing private credit. It's more a question of increasing allocation or starting to invest in private credit.
Okay.
And I think that again is just a factor of market environment and the desire to have yield the perception of risk, and that you're in a different place within the cap table, and that allows you to hopefully generate some returns in the short term. Again, it comes back to that liquidity question around we're not seeing much liquidity. How can I invest in things with a shorter duration that allows me to get some capital back in the meantime that will help me deploy capital into new opportunities?
So okay, now let's say when we come to private credit, since there's a lot of activity happening in, let's say, the last year or so, do you think that it's already oversubscribed from the MENA portfolio perspective, or do you think there's still
I think there's still room to go.
Okay.
And I think, again, there's some sort of hybrid sort of structures that allow investments into both credit and equity that is quite attractive to a lot of investors in this region. So I think that portion of focus will grow. I think it's very nuanced and depends on the individual investor, but there's definitely room for private credit to increase exposure within people's portfolios in this region.
So when you talk about hybrid, could you break that down a little bit more?
Yeah.
How does that look like?
So these are normally opportunities that within a particular fund give the investor the opportunity to have exposure to both equity and credit.
Okay.
Which obviously have different risk profiles, coming back to what I said earlier. And often that allows for what some investors may view a different risk-adjusted return profile. And as part of that, they sit sort of between their private debt allocation and their private equity allocation. The challenge with that sometimes is, for some investors, which bucket does it go into? But I think as people move to growing as investors move to growing their private credit allocation, it's a natural step in between.
Okay.
As you move sort of down the risk curve.
So I have heard a lot of these sponsor deals where private equity funds then start private credit funds and sponsor their own companies. And how often do you see that happening?
It's increasingly happening.
Okay.
Again, it's one of the areas where it can make sense. I think the challenge often is how do you manage sort of conflicts of interest within that. But often when GPs know particular businesses incredibly well, and the availability of bank-type financing is a lot harder to achieve these days, given regulation and Basel requirements, it can make sense to have exposure to your own portfolio via credit strategies. I think the question then is, how is that being managed? Is it a separate team? Does it have the right expertise? Clearly, when you know the portfolio inside out, it makes it a lot easier.
So as an LP, is that a good thing for me or no?
Again, it really depends on the LP. It can do. It depends on your portfolio construction and your risk tolerance levels. I think the one thing that LPs have to consider is how much exposure they have to a particular GP as they think about their own diversification. And sometimes it's better to focus on the pieces that the GP knows really well and the strategies that the GP knows really well, and maybe that makes sense as part of their credit strategy. Maybe it doesn't, and you prefer to have a different exposure and diversify the amount of GPs you have in that portfolio.
So what is the macro theme like right now? What do you see happening in the market? How are LPs reacting to it? And especially with, the US, the whole Trump administration coming into the picture, how has it changed? How are LPs looking at it?
I would say the key word is uncertainty, and that makes things difficult from an allocation perspective, because things can change quite quickly. I think what is important to realize in private markets, it's a very long-term asset class. So we're not thinking about what's happening in the next 6 months or the next 12 months. We're thinking across decades. And as part of that, I think you can somewhat ride out a lot of the short-term challenges that uncertainty brings, but it just makes decision-making difficult.
Okay.
And sometimes you are at risk of making decisions that are based on short-term inputs without having the ability to really understand the kind of long-term potential implications. And that's just very difficult to do in an uncertain environment. So, coming back to the point around slower distributions, I think LPs are naturally pacing their own investment cases accordingly and taking that into account, and assuming that in a number of cases they probably have longer hold periods that they anticipated or that the GP anticipated. And therefore, you have to maintain some dry powder, some capital to be able to fulfill your future investment requirements that you've committed to but haven't yet drawn on. So I think it's really, uncertainty is never good. It makes things more difficult, but we're in a long-term asset class, and that means that in the long term we can deal with that.
Yeah. So what are some of the things that you think LPs don't really look at that they should, and then later on kind of realize, okay, this is something they should have looked at earlier on?
Yeah, it's a good question. I'm trying to think of things that LPs don't really look. I think most LPs, certainly in this region, are very sophisticated, and so over time they've developed, their skill set very effectively to be able to assess and address most cases. I think probably what has had less focus over time has been sort of the global macro piece, and how that might impact particular portfolio and I think portfolio events. And I think if you look at COVID, for example, or you look at tariffs, etc., very difficult to sometimes foresee or predict these things. So I think what you will see is LPs greater acute focus on what are the things we're not thinking about in terms of what we're investing in, what are the risks, and how do you create buffers into your investment decision making that allows for the things you can't predict.
Okay, got it. And what are some of the mistakes you think GPs make?
Well, I think in this region, I think the main mistake is that it's easy to raise capital from here. So what I would say is it's a very sophisticated market.
Yeah.
And I think there's probably was a perception, maybe there is still amongst some GPs, that it's relatively straightforward. There are a lot of things that need to align to be able to raise capital in this region. So I think you just can't take that for granted. I think it's also not about the amount of time you spend here. So you have to spend time at the right time, but not necessarily come here every 3 months to spend time with an already busy group of LPs. And then it's about understanding the needs of LPs. And that comes back to the earlier point where I think, we bring particular value. It's really, what are you bringing to this LP that is value add to them that other opportunities are not bringing? And how do you communicate that to the LP in the most effective way that resonates? And you have to bear in mind that most of the LPs in this region are heavily oversolicited.
Okay.
So you really have to focus on being very concise, very sharp around what you're doing and why you can bring something that others can't.
What are some things that LPs really appreciate, but GPs don't realize that is something that they should do?
Well, the first one I think is transparency and honesty.
Okay.
And from my perspective in particular, I think it's really important that you're very upfront and clear with LPs around what works well and what doesn't work well. And clearly LPs are not expecting everything to work well. Nobody's perfect. But as part of that, I think if you want to build a long-term relationship, it has to be built on trust. So you have to be very open and honest and not try and smoke and mirrors around challenges, because LPs will find them out. I also think that as part of that, the story should always get better over time. And what I mean by that is if you present a very rosy picture in the first meeting, that's great. It might get you the second meeting. but once they dig into the proposition, if
Yeah.
you find things that are not quite right, it's going to end that relationship.
Yeah.
So I think it's really important to be very transparent, open, and honest. I think the other thing is just in terms of understanding LP needs and not being transactional about that. So, again, coming back to sort of co-investments and direct investments, which are a big focus of this region, you often have GPs thinking, okay, I've got a co-invest opportunity. Let me just go and see if I can gather some capital from the region with this co-invest opportunity, and that's fine. But actually, it's more important to think more strategically around what are the right co-invest opportunities for the right type of investors? How do I ensure sort of early engagement with them, over time, so that you can build a relationship where when that comes, it fits more naturally into something they'd want to have a look at. All these things are really quite important.
So as an LP, right, once they have invested, they've committed capital and everything, how involved are they with the GP?
Again, different LPs have different preferences. I would say in this region, generally speaking, very involved.
Okay.
And particularly for the larger sovereign wealth funds, that regular dialogue to ensure that they're seeing the right kind of co-invest deal flow as part of that engagement is important. Obviously, some of the family offices prefer more limited engagement. It may be around an AGM or a visit each year from the GP. But I think what is important is to have very open and transparent dialogue and communicate early. And sometimes things aren't working out for whatever reason, but ensure you explain to the LP why they're not working out and what you're doing to solve them. And I think that proactivity of dialogue will really help in terms of the long-term relationship.
What is an AGM and what really happens?
Yeah, so the AGM, or the annual general meeting, or annual investor meeting, as you may call it, is a meeting that happens once a year, which the GP organizes and invites all their investors to.
Okay.
And it's an opportunity for them to present where they are 12 months on. So where are the investments? How are they performing?
Yeah.
Often it's an opportunity for some of those investors to meet with the portfolio companies, the CEOs, the CFOs, and also to get a flavor of the market environment, where the GP sees opportunities, what the pipeline looks like, all these things. And in particular, it's also an opportunity for LPs that are invested in a fund to network with other LPs.
Got it.
So that's really important because they can share ideas and thoughts around that GP and other GPs.
Got it. Now, I want to ask you, what still excites you about being in the region? I know you've been doing fundraising for a very long time. What do you enjoy the most, and what do you think is something that probably you don't enjoy as much?
I think for me, it's the people aspect, right?
Okay.
So I think I'm very lucky in that I get to spend a lot of time with some very smart individuals, both LPs and GPs, and I get to learn a lot from that. And I'm quite intellectually curious around portfolio companies and the mechanics of how they operate and things. So I get a very nice exposure to a lot of very interesting people that intellectually is super interesting. And the flexibility and dynamics of this region and other regions that I spend time in that every investor is different, all their needs are different. How you tailor your approach to that and really think carefully around how you're bringing value to them. I think that's really important. What I don't like so much, I continue to travel a lot, and it'd be nice to travel a little bit less from time to time.
Fair. Which regions do you travel the most to?
So most of my time is spent traveling around the GCC, but also into the US and into Europe, Switzerland, Spain, Italy, etc. So it's a very global kind of perspective. In Asia Pacific, we have a dedicated team, a large team of very smart and experienced people that cover those investors and do so really well. So I spend less time in Asia, but I do spend quite a bit of time beyond MENA in Europe and in the US.
So this brings me, what do you think about the Saudi market?
So I think the Saudi market is evolving.
Okay.
So there's a very large family office cohort in Saudi Arabia that have historically invested more domestically, particularly in real estate and in local investments, and have over time started dipping their toe into private markets. So that has probably started with some of the kind of larger global names, the very large firms, but are looking to diversify that exposure more broadly into more mid-market and lower mid-market opportunities. And that I think is really exciting. It's something we can really help them with, and that we, I think over time will grow to be a real big powerhouse of the private markets environment in the GCC.
Do they have enough liquidity going on? They don't have any liquidity issues or something like that?
Look, I think like everything in this region there's ebbs and flows. And so you naturally have moments where some groups may have overcommitted or have deployed quite a lot of capital and have slowed down, and other times when groups have perhaps not invested as much and feel like they need to spool up their investment pipeline. So it's very difficult to draw conclusions from that. I think over time you'll see the capital flowing into private markets continue to increase as people get more and more comfortable with the asset class, the returns that they're expecting, and how it works in practice.
The final one would be, I first want to congratulate you for Placement Agent of the Year. I just saw you on that, and also the PEI Leader. I want to understand, like, fundraising is not an easy place to be in, not an easy market. There's so much competition going on. What is one thing that you think helps you the most in terms of your discipline, or something that you do that would definitely, like, ensure success?
Yeah, look, I think, and thank you for that. I think it's around being intellectually curious and being transparent and honest with the people you operate with. So it's all about trust, and as people get to know you and they understand your integrity and how you operate, that pays dividends not just in your relationship with them, but in the way they introduce you to other people, and that ecosystem kind of continues to grow. So I would say just being very honest and transparent in the way you operate, and ensuring that you do things for the right reasons.
Good. Thank you so much. I really appreciate your time.
It was a
and
pleasure.
I know you're traveling, so safe travels.
Okay. Thank you so much. It was a pleasure to be with you today.
Thank you for tuning in to Unfiltered Investments with me, Damini Mulchandani. I hope you enjoyed this conversation and learned something new about the world of investing. Don't forget to follow, subscribe, and share this episode with someone who'd love to learn more about finance. The views shared in this podcast are personal opinions for educational purposes only and do not constitute financial advice. Please consult a licensed financial professional before making any investment decisions. Thanks again for listening, and I'll see you in the next episode.